Welcome back to the another video on stock exchanges. Currently in this unit number 1.4, we will be learning about the various stock exchanges in India. First of all, we should be understanding the meaning of stock exchanges. So let's understand. Stock is nothing but a small ownership of the company. And this small ownership, you have to buy it from somewhere. So we have a marketplace where we call it as exchange. Suppose, for example, you must have seen there are lots of vegetable markets. There, the buyers and the sellers come at a single place and they buy and sell the vegetables. In a similar fashion, when we talk about the stock exchanges, a stock exchange is an organized marketplace where people buy and sell shares of companies as well as other financial products like bonds and derivatives. It works under rules so that trading is fair, safe, and transparent. So, the key point here is that share is nothing but a tiny ownership pieces of a company where the investors and the buyers of the shares come into the place and ultimately they come together and buy this. Another very important point here is that the transparency with which every prices and the transactions can be seen. So moving ahead, these are our learning outcomes from this particular session. We will be understanding the role of the stock exchanges. We will be able to identify the different stock exchanges and its types. We will be able to understand the key market indices, that is the Sensex, Nifty 50, and their significance. Next one, we have the technological advancements that has been done in the trading. And the last one, who is the regulator of this market? That is the SEBI and its role. So here comes the introduction of the stock exchanges in India. Stock exchanges, as I just introduced to you in the last few minutes, that is, stock exchange are the crucial components of the financial markets where various type of securities such as the stock, bonds, derivatives are traded. It is nothing but in a small, simple language, if I say that it is nothing but a marketplace where the buyer and the seller comes at a single place and they buy the shares and they sell the shares. So ultimately, this is the introductory part. Now, there are some key words below that I have given on the slides: capital formation, economic growth, investment opportunities with some SEBI regulations. These are the key words from this particular slide. The capital formation is nothing but how much a company will be able to have the capacity to produce more. That is called as a capital formation because ultimately, whenever a company is there in the market, they want to expand. And to expand more, they have to produce more. And for the purpose of producing more, ultimately, some amount of capital formation, which is nothing but the capacity of the company to produce more, that needs to be done. And the simple process of capital formation is nothing but The savings that is done by the people in the market should be invested in such a form that the companies will be able to expand the market. Next up, we have the economic growth. The more companies grow in the market, ultimately they will be able to produce more. And if they are able to produce more, they will be able to hire more people. And if they are able to hire more people will be getting jobs. And ultimately, there will be economic growth, and the per person's income will also increase, which ultimately rises, or you can say the country's growth rises with the help of that. So economic growth is the another keyword. Next up, we have the investment opportunities. There are many people currently who are making a fortune by just having a proper guidance and investment opportunities in the market. There are many people as well on the downside that they are losing their fortune as well. The only problem here is a lack of education of that particular opportunity. So ultimately, whenever we have to find the investment opportunities, we will be able to identify where the fortune can be made. Next up, we have the SEBI regulation. This market, that is a stock exchange market, is regulated by the SEBI, and SEBI takes the full regulative and the rules regarding the stock markets. So here is the introductory part. Now, moving ahead with the first stock exchange, that is the National Stock Exchange. We must have heard many a times about this word, that is the National Stock Exchange. This National Stock Exchange, that is NSE in short form, is one of the largest and prominent stock exchanges in India. When I use this word national, it means for the whole country. It was established in 1992, and in this NAC, that is the National Stock Exchange, this platform provides the trading for equities, that is nothing but the shares, futures, we have options, and other various types of financial instruments. So it is not only facilitating the trading of equities or the shares, but also other type of financial instruments as well. Following are some of the features of the NSE. The first feature here we have is that the electronic trading. The NSE provides full disclosure and the trading is done electronically. Previously, we used to have a hard copy of the shares. A hard copy of the shares. Whenever you will be buying the shares, you will be getting a certificate type of share where they will be writing how many shares you bought, at what price, on what particular date, and the signature and the other stamps of the companies, and your name will be written on that particular share certificate. But now, as we have digitalized the whole concept, so ultimately NSE is also on the same route where they have electronically made all the trading possible. So it is fully automated, and the number of errors is almost nil. There will be there will be a new number of liquidity and a huge number of liquidity. The NSE is highly liquid due to its broad participation. Why? Because the whole country is doing the trade on NSE. That is why the liquidity part is very high. When I say liquidity part, it means the cash component. How much cash or how much easy it is to convert into cash. That is why we can say that NSE has the most or the highly liquid participation in the securities market. There are few indices which are there under the NSE. The first indices, as an example, we can have Nifty 50. NSE, this index is a benchmark. which shows what is the trend currently going on. The number 50 is nothing but the top 50 companies. The 50 denotes the top 50 companies across various sectors. And the Nifty is nothing but a short form given for the National Stock Exchange, Nifty 50. Okay. So Nifty 50, we have the top 50 companies under that. And the next 50, we can say the next 50 companies. Here we have Nifty next 50, which are apart from this 50 top 50 companies, the next 50 companies, which are the prominent indices. So it is nothing but if all these top 50 companies are going upwards, the market shows an upward trend. If these 50 companies start declining altogether, or the majority of them goes down, then we can say they all are going in the downward fashion. So it is a kind of crash like situation. Next up, we have Bombay Stock Exchange. It is currently the oldest stock exchange in India. Also, it is one of the oldest stock exchanges in Asia as well. It was established in the year 1875. Here it is, in the year 1875. And Bombay Stock Exchange holds a significant role in the whole country. As the name suggests, Bombay, it is it is the previous name of Mumbai. Currently, what we know as Mumbai, previously it was Bombay. So, on the basis of that, we have kept the name Bombay Stock Exchange. It is one of the regional stock exchanges, but currently, due to its highly liquid formation, and most of the companies are there in Maharashtra and Mumbai. So that is why this stock exchange is one of the most famous stock exchanges in India. NSE and BSE, they were started in very different times. NSE started in 1992, but in Bombay Stock Exchange, you will find the year 1875. So it is one of the oldest one, which is currently still running very high. In the second feature, you can find that around or more than 5,000 companies are there listed on the BSE. When I use this word listed, it means you have to take the permission and you have to fulfill some forms. And after only fulfilling those forms, your company will be listed. Listed means what? You will be put up in the list of the companies of the BSE Bombay Stock Exchange. Listing is very important. Otherwise, your companies will never be shown on that particular list. Now, suppose if for given example, there are some companies which are running very successfully on the local level, but you will not find their name on BSE, that is Bombay Stock Exchange, as a market. In this market, if you want to enter and if you want to take some money to raise some capital, you have to list your company. That is called as listing. Next up, we have some indices under the Bombay Stock Exchange. This is Sensex, that is sensitivity index, BSE 100, that is Bombay Stock Exchange 100. And in a similar fashion, where I told you in the previous slide, Nifty 50, these were the top 50 companies. In a similar way, the word Sensex that we have in examples, these are the 30 top companies which are listed, and they show the benchmark or a type of indicator which will tell you whether the market is going up or it is going down. So these are the indices. It is a set of benchmark. So we have two prominent stock market exchanges which are very famous and currently running very high. So we have one Nifty, which is of NSE, and another one we have Sensex sensitivity index, that is for BSE. So currently these two are the one which have the majority of the shares, and it's running and shows the benchmark for the market. There is another S&P BSE 500. It is also part of another index under Bombay Stock Exchange itself. So this shows the 500 stocks listed on BSE. Okay. Next up, we have some regional stock exchanges. What do you mean by regional? Just like I told you in the last slide that Bombay related to the Mumbai, we have a regional stock exchange there. In a similar fashion, we had other stock exchanges from various regions. The first up on the left hand side, you will be able to find the Kolkata Stock Exchange. The Kolkata Stock Exchange, CSE. In the middle, you will be able to find the Ahmedabad Stock Exchange, ASE. And the last one, we have Madras Stock Exchange, that is MSE. Although all these stock exchanges were started for a very specific purpose, and the purpose, you all know it, that the buying and the selling for this particular region. And although it looks very um, attractive that we have all the different type of stock exchanges in India, but currently the Kolkata Stock Exchange, the Ahmedabad Stock Exchange, and Madras Stock Exchange does not function as such. Following are some of the reasons which I will be telling you now. Kolkata Stock Exchange has effectively been halted since April 2013 when SEBI banned Kolkata Stock Exchange from trading due to persistent compliance issues. Now, what is the compliance issue here? The compliance issue here is that they had to maintain some minimum amount of turnover, net worth, which they were not able to meet. The minimum trading turnover of 1000 crore per year, which is required for a continuous operation, the rule has been given by the SEBI. But ultimately, when Kolkata Stock Exchange was not able to fulfill that, so they had to exit this market. Now, what is the reason of 1000 crore per year? The reason is liquidity. If you do not have the liquidity in a particular stock exchange, you will not be able to get the ultimate result of the stock exchange. And the another reason is the dominance of BSE and NSE, that is the Bombay Stock Exchange and National Stock Exchange. The second one, we have Ahmedabad Stock Exchange. What went wrong there? In simple terms, if I tell you, the reason is very similar. It was although founded in 1894, but Ahmedabad Stock Exchange had to take an exit, and formally it was closed down in April 2018. In April 2018, this was also closed down. What happened to the Madras Stock Exchange? This also was closed down from the year 2015. All the three stock exchanges had a similar problem, which I'm quoting the common reasons. SEBI's 2012 exit policy, where it was mandatory and it was made compulsory for all the stock exchanges to have a turnover of 1000 crore or more. If they are not able to meet this particular criteria, they either can merge with a bigger exchange or they can apply for a voluntary closure. Second reason was the technological gap. The gap in the technology was huge because the NSE and BSE were very high speed and fully automated nationwide trading. They were giving all these facilities. But in terms of Kolkata Stock Exchange, Ahmedabad Stock Exchange, and Madras Stock Exchange, they were not able to have that much amount of good amount of technology. So ultimately, they had to close down. The next one, we have the low liquidity. The liquidity was so less that if you want to sell your shares, you will not be able to find a buyer. So that is the reason the low liquidity caused another problem and pain for all these three stock exchanges. And the last one was the regulatory burden. SEBI is the one who takes care of this, and SEBI made it very clear that the cyber security, all the compliance related issues, and the investor protection is the topmost priority for SEBI. And all these following stock exchanges were not able to fulfill that. So they had to leave this particular market. Next up, we will be going for commodity exchanges. Now, in the previous three slides, we saw NSE, BSE, and regional stock exchanges. But commodity exchange means, in a simple term, if I say that these are the goods exchange market. Under this goods exchange market, we have different type of raw materials as well as the primary products. For examples, you can take precious metals like gold and silver. You can take example of agricultural commodities such as wheat, oil seeds, some crude oil, etc. Below are the two few examples. First one is Multi Commodity Exchange of India, that we call it here as MCX. This is nothing but where you will be able to exchange the commodities. Following are the examples, that is the metals, energy, and agricultural commodities. The second one, we have National Commodity and Derivatives Exchange, NCDEX, where it was specializing only for the agricultural products. For example, wheat, maize, soybean, oil seeds, etc. And this serves the needs of the farmers because they are the one who are suffering to get a market. So NCTEX was that platform where they will be able to sell that particular product. Next up, we have over the counter market. Over the counter market was launched in 1990, and for that it was specifically made for small and medium sized companies to raise the capital without listing on BSE and MSE. Now, if you know, during the time of 1992, we already had NSE and BSE was also in existence. But with the growing dominance, it was very much important that you had to list your companies in these two. But there are some small companies which will not be able to fulfill all those criteria. So ultimately, the smaller and the unlisted securities, such as government bonds, corporate bonds, or small cap stocks, could not meet the listing requirements. They will be able to sell their or exchange their shares in this particular market, that is over the counter market. We have one example right in the middle, that is the OTC Exchange of India, that is over the counter exchange of India. The short form here we have OTCEI. It was established in 1992, in the same year when NSE was established. Currently, OTCEI is no longer operational because they found some roadblocks during this time. The NSE and BSE, they introduced small medium enterprise platforms for better liquidity. So that is why over the counter market could not survive this. And another reason when OTCEI could not survive was very low investor interest and trading volumes. The trading volume was very less. So liquidity question was always there. So due to that reason, OTCEI does not exist currently. Although OTCEI is closed, although this is closed, but OTC market still exists. Now, how does it exist? Because there are other securities. For example, in India, I'm telling, government securities and corporate bonds can be sold in this market. So they are currently being sold. The currency derivatives and interest rate swaps that can also be done, which is regulated by the RBI. And there are some unlisted shares and startup equities which can be also taken into consideration. So, in summary, in short, if I tell you that OTCEI is closed in 2015, but OTC still exists for bonds, currencies, derivatives, and unlisted shares, mainly among institutional players. Okay. So, the key features here we have direct trading. Direct trading means where the buyers and the sellers will be able to come through a network of brokers and they will be able to customize their deals. So you will be able to have a good bargain. You will be able to know at how much you will be able to sell it off. Secondly, we have less amount of regulation under the OTC market. As the formal stock exchanges, that is the BSE, NSE, they have a lot more regulations. So they were there in the market. But here it is less regulated. And this is also another problem for this OTC market. As it is less regulated, they have a potential higher risk of not getting, of the exchanges not getting executed. Next one, we have flexibility. This offers a greater flexibility. Flexibility means you can change your contracts during the OTC market. So here we can take some examples of unlisted shares or any other unlisted shares where you will be able to do the justice. Next up, we have currency exchanges. Under currency exchanges, as you must have understood till now, that it is another again a market where the currencies of two countries can be exchanged in this particular market. For example, we have some examples given here. Indian rupee, US dollar, Indian rupee, European euros, Indian rupee, Great Britain pounds, Indian rupee, Japanese yen. So you can come into this market and you can sell and buy the currencies. So this is why currency exchange was also there in the market. Okay. So it is regulated by whom? Very simple terms. If I tell you, it is regulated by SEBI and the RBI both. It is little different from all the other currency exchange, from all the other exchanges that we had talked about. Second one is market liquidity. They are highly liquid because it is not only a regional aspect now, it is international. So there are many buyers and many sellers in this market where you can buy and sell your currencies or in your interested currencies and you can do the transactions. Third one, we have another feature that is the hedging opportunities. Now, what do you mean by hedging opportunities? There are some transactions when businesses can have losses because the exchange, or you can say the transaction execution of the amount, could be done in future. So suppose you have ordered something today, but the payment of it will come after 90 days or 60 days. During that time, your currency exchange might change. Suppose currently, if it is $1 is equals to 80 rupees, I'm just taking an example, and after 90 days, it might go and increase from $1, 80 rupees to 90 rupees. So, what will happen? The person who is going to pay the money during that transaction will be having a loss. So, for that, we can have hedging contracts where a broker or the hedger can make a transaction with that particular party. So it can protect the revenues and the cost in the businesses. This was about the currency exchanges. This is your summary. We have learned about the Nifty, NSE, Nifty 50, National Stock Exchange. We also talked about Bombay Stock Exchange that has Sensex as an index or the benchmark. We saw some regional stock exchanges, which was about Kolkata Stock Exchange, Ahmedabad Stock Exchange, and Madras Stock Exchange, and why they have closed. Commodity exchanges where platforms like MCX, NCDEX we saw, and their examples metals, energy, and agricultural products. And at the end, fifth and sixth, where OTC market, where a direct trading platform was given to the buyers and the sellers. They can have direct transactions. And at the last, we have the currency exchanges, where we can say the NSE and the Metropolitan Stock Exchanges of India coming together, and they will be having a currency exchange in the market. This is the summary. Thank you. This was presented by Smiran Garu. That's my name. And with this, I will end this session. Thank you.